Hey, it's Cara Riley, and welcome to the Transition Living Real Estate Team monthly event. We are a group of realtors and resources, and I'm here today with my partner Declan Kenyon and Don Opeka from Orion Mortgage. And we are a group of real estate agents and resources that help people navigate the challenges in transitions in life. And so we've been presenting our events live at the Heritage Todd Creek Golf Course in the clubhouse, and we've migrated now to a Zoom room. And the good thing about a Zoom room is that we can record the event and then we can share it with people who couldn't be available for this hour during the day. So we're excited about that, and you'll be able to see in the chat how to access and to get on our subscription page, where we'll send you things each month about the events that we're having. So today, I'm really excited to present Don Opeka, and he and his wife, Terri, have been helping people with mortgages in Colorado since 1996. My husband Tom and I started going to reverse mortgage events about 3 years ago, and we had been to 6 or maybe even 7 to kind of understand it, because the old reverse mortgages had a very negative kind of reputation. And then we went to see Don and Terri, and all the dots started to connect. So I'm really excited to have him as a guest today. So we've got 5 areas we're going to go over. If you're running out of money, if you want to spend time in a warm weather climate, if you're looking for home equity, if you want to not spend your IRA or investments when the market's down, and if you need to stop your current mortgage payments. Those are the things we'll be going over today. And Don, it is my pleasure to present you and share with our viewers about a refinance reverse mortgage, because that's what you specialize in, refinancing with a reverse. And if you could start out sharing with us just exactly what is a reverse mortgage.
A reverse mortgage is a mortgage product where you borrow the money. Payments are optional on it. You do not have to make any payments during the term of the loan. We add the interest and the mortgage insurance to the loan balance each month, and then the loan comes due whenever you leave the house. The requirements to stay in the house are that you pay the taxes, pay the insurance, and live in the house as your primary residence. As long as you do that, pay taxes, pay insurance, maintain the place, and live in it, and you can stay until age 150. Nobody's made it that far. You can make payments on it. You can amortize the loan just like any other loan. You can pay down lump sum amounts at any time. There's a lot of flexibility to the product, but the fact that you don't have to make any payments is a big deal on these loans. We'll be talking primarily about the FHA product. There are some non-FHA products in the marketplace, but they're generally more attractive for homes over $1 million, which is not the typical price point in our market. So we'll focus on the FHA product today.
Well, Don, thank you so much, because I think it's really important that people understand that with a reverse mortgage, you don't have to make payments if you don't want to. So we'll just start digging right in. Let's start right at the top. If you're running out of money and you haven't planned for the assisted living or the memory care, because sometimes people don't want to think about the worst it could be. That is not where your mind goes, and especially when you've got lots of things on your mind, that is not something you want to think about. So let's just have a little bit of a conversation about how that all works and what happens, because it becomes a crisis if something happens, and then trying to mobilize your funds in advance is very hard. So let's just start
That
with some stories
what
on
you're
that.
alluding to, what you're alluding to is such a common issue that I see, that I've made up these buttons that say denial does not prevent aging. And I pass those out at various senior events because the people don't want to talk about this until the money does run out, where it becomes a whole lot more attractive, in my view, to get the reverse mortgage in place whenever you don't need the money. It's not a crisis, and you can do it in a nice, orderly way. You can set it up, as you mentioned, as a line of credit. Some people like the home equity lines of credit from the bank. They are much less expensive than a reverse mortgage to set up. But the problem with them is that they run for 10 years, and at the end of 10 years, if there's a balance on them, you may have to refinance the loan. We've already seen a situation of a man who got a home equity line of credit when he was in his mid-70s. The loan came due in his mid-80s, and it became a problem to refinance it at that point because of income issues. If he'd gotten a reverse mortgage in the first place, it could just keep rolling. The available credit would increase with time based on the interest and the mortgage insurance rate. And I advocate looking ahead, either to set it up as a line of credit or to eliminate a mortgage payment. One of the ways we've seen it is a lady in Longmont. She and her husband were doing just fine with a mortgage payment, both of them on Social Security, until he died. And when he died, the one Social Security check went away, and she was in a situation where she couldn't make the payments on one Social Security check. By eliminating the mortgage payment with a reverse mortgage, she was able to live in her house and stay there. The taxes, insurance, and maintenance on her house were projected to be less than what she'd pay on her share of Section 8 housing. So given a choice between stay in a house or try to get on to subsidized housing, it was a pretty easy choice to say stay in a house. And if she wanted some more income in her house, she could rent out an extra bedroom and pick up some money there. I've got one client who not only did we do a reverse mortgage to get rid of her mortgage payment, but then she rents out a basement apartment. She rents out an upstairs bedroom. She has her tenants trained to do her outside yard work and her cooking for her. They're paying her to keep her in her house. And I don't know how you get less expensive living than that, but she's in a pretty nice house down in Parker.
I think that's a
Those,
really key factor here, Don, that I want to like really emphasize, that the way we are going to live and age is going to be very different than it has been for the past decade or almost 2 decades, because we're coming into a period where there is going to be some job loss. There is going to be a loss of credit, you know, where people are going to have some problems, and how we work through it. It could be like the Waltons, you know, where we have all the generations that are moving back into the house. And if there is no mortgage payment on the house with a reverse mortgage, you can have different generations in there, and they can be doing their saving up while they're getting their credit back together. I think, and there's an awful lot of people, I think it's 10,000 people a day are turning 62 that for quite a while. So some of those people have not planned for living and paying all the expenses, your cell phone, your insurance, the tax, just everything that comes into home ownership. So it could be, we see people going into like a rooming house situation, and that's what you've been describing. And I think that's something that we may see coming up especially too when you haven't planned for having to go to memory care. My experience has been, and Don, you jump in here, that if you have to have somebody go into memory care, it's almost $8,000 to $10,000 a month. Is that what you're finding?
Those are kind of numbers I hear. It can be more than that even. But the transition becomes easier, let's say, for the person who has a reverse mortgage in place, and they need to have it in place before they're heading to the memory care place. But if it's in place and has been there for a while, and they can tap some money from the reverse mortgage to start their time in the memory care unit, then the house can be sold in an orderly way and the equity used to continue paying for the memory care unit. And eventually they may end up on Medicaid. They may have to do a Medicaid spend down, but all that can be done rather orderly. I've run into the situation where somebody called me, mom was already in memory care, can we get a reverse mortgage to pay for some care for a while? And the answer is no, because she no longer lived in the house. And at that point, it created a difficulty. We've also seen a situation where a lady with early stage dementia was still living in her house, planned to stay in her house for a while, but keeping her in her house was draining siblings' resources. And so by doing a reverse mortgage, we could stop the drain on the siblings' resources, keep her in her house for a while longer, as long as she could stay there. And then when a time came to do a transition to some kind of a facility, should still have equity to pay for a facility. So it made the situation, I think, a little more orderly to have the reverse mortgage in place, helping that. The other situation that you just alluded to was the issue we're going through right now. I've got one client who, when this coronavirus thing hit and we had a little volatility in the stock market that you may have heard about, found themselves down about $300,000 on their investments, and it becomes a little distressing if they need to liquidate assets in a down market, where with a reverse mortgage, they can pull the money out of the reverse mortgage instead of out of the stock market, let the stock market recover, and then liquidate assets whenever the values have recovered to pay off the reverse mortgage. And it becomes one more product in the financial portfolio to be used to manage the money. It's all about, it's not so much, in my view, about you got to have a reverse mortgage, but I see it as one more tool that people should understand can be very useful for taking these swings in the market and not finding themselves liquidating assets that may be depreciated significantly.
I think that's really good that we're bringing this up here. And if you're looking at our outline, it would be more like number 4, if you want to save your IRA or investments in liquid assets, because you can borrow and have no payments. I think that's the biggest thing that people who are listening have to realize, that there is no payment. You won't have to pay it back. Now, the big key is,
now wait a minute.
Go ahead.
You do have to pay it back. It's not free money. Okay.
Yeah.
They get paid back at the end.
At the end.
You just don't have to make the payments along the way.
I was jumping to the final bankruptcy. You know, that's when you check out. You know, you have your final exit plan. But anyway, right. No, again, no one wants to talk about that. But so at the end, it will be paid. And but for monthly cash flow, you have access to the equity in your home while you're still in it with no monthly payments. Is that right?
Right.
Right. Okay.
You don't have to make any monthly payments.
Yeah.
And if it's in place, like ours is, if we need access to the money, we get the paperwork each month with our statement. We can fax it in, and a week later, money shows up in in a checking account, where I've had the situation where I got the call on a Tuesday saying we've got somebody leaving the hospital on Friday. They need $16,000 for a rehab facility. What can you do? And the answer was nothing, because it just takes too long to get a mortgage given federal guidelines today. It just wasn't going to happen between Tuesday and Friday in today's market. There's the minimum time you hear on the radio is 10 days, but that's if everything goes perfectly. And if somebody's in the middle of a healthcare emergency, it's not going to go quickly or perfectly.
Yeah, and that brings up another point. We're with the money changes that we're seeing with lenders. There are already lenders who are not going to offer home equity lines of credit. And, you know, in the early 2000s, we had lenders calling their line of credit saying, we're not going to give you any more. Okay, so even though we had a piece of paper that says you can have this line of credit for 10 years, they took it away. And that can't happen with a reverse mortgage. So at least if you get it in place now, you have your own bank that you can pull from. And then the other thing is, now let's talk about actually paying some of it back to free money back. If the market turns around and if there is money coming in, you can use that money to pay down what you've not paid during the time, the negative amortization. Is that correct, Don?
Sure. Or,
Yeah.
I mean, you can, I have one lady that is making payments on hers. She just pays the interest and the mortgage insurance each month to keep the balance level, which means that she has a growing line of credit. I have another client who inherited a house in California. They're going to sell the house, and he told me he was going to pay off the reverse mortgage, and I suggested that he leave a small balance on there so that if he needed money, he could get it back. And he could do,
Yeah.
like in our case, I've got about a $700 balance on it just to keep it open. And but that way we've got access to the money anytime by just sending the paperwork and the money comes back out.
Yeah, that's
Where it
great.
is.
And the other thing that you kind of alluded to in the first opening portion about spending down to get on Medicaid. Okay, I think this is a key factor that people have to realize. Medicaid comes in and covers when you don't have enough money. But to find a facility that takes Medicaid right up front, that's almost next to impossible. So what the facilities are looking for, and you'll this afternoon, if you go to Don's event this afternoon, you'll hear more about this, but they are expecting the guest to be able to pay for several years and have the funds so that if they come into the facility, they'll be able to pay for their room. Now, when your money runs out, because if you're paying $10,000 a month for memory care, your money can run out pretty fast, okay? So if you've had that reverse mortgage in place and your money all runs out, you still are going to be able to qualify for Medicaid. Is that correct, Don?
Yeah, you can actually, Medicaid will let you stay in the house, and they will pay for medical care. There are a number of programs under Medicaid that can provide care while you're in the house, or they can provide care in a facility. I do not claim to be a Medicaid expert, but I do know people who are. And so if the issue of Medicaid is something you want a longer discussion on, happy to do that. Happy to put you in touch with the appropriate resources on it. I just have an overview of it, and in round numbers, it's when you're down to $2,000 in assets, $2,000, $2,100 a month in income, a house, one car, your personal property, and at that point, Medicaid will start to pay the bills. But then what they do is they run a tab on it, and they come back, and when you're gone, they do an estate recovery, and that's what this is about. If somebody's interested, I can send you the packet on how the state handles estate recovery on Medicaid. A lot of people don't realize that if they run out of money and Medicaid pays the bills, that Medicaid is between the house and the kids as far as a claim on the house. It's an interesting
There's no free
situation, but
lunch that the
no,
estate is
there's no
going to
free
be.
lunch.
Yeah, the estate is
Yeah,
going to be paying back what the government has paid for you to be able to age gracefully, basically.
right.
Is what that is.
So
So, okay, well, let's get more exciting. Let's talk a little bit about getting a reverse mortgage in place, and you can use that money for whatever you want. If you wanted to use it to buy an investment property in Florida or in Arizona, tell us a little bit about that and what you can do with the money that might be more positive than waiting to check out.
well, one of my clients used it to a reverse mortgage to pay for his around the world cruise. Spent 5 months and $70,000 on the cruise. So for he and his wife. So that's one way to use the money. It is your money. It's a loan. It's not taxable at the time you get it, and you can use it for whatever you want to use it for. The only caveat is that you can only spend it once. When it runs out, it runs out. But it can sit there for a long time, growing with time. The amount of money that you can access out of a home that's free and clear will be at age 62 somewhere around 40% of the equity, and at age 80 you're up around 55%, and it goes up as you get older. The reason why those limits are in place, and FHA sets the limits, are based on your age, because there needs to be enough room in there to cover the interest and the mortgage insurance until you turn 150 years old. And they really don't want to lose money on these things. They want you to have enough equity in the property at the end, so that you or your heirs at the end will sell the house and walk away with some cash. Lots of people think that the bank owns the house. They do not. They don't want the house. They don't want to foreclose the house. They want you to have equity in the house all the way to the end, and just lend you some money. Then they want the money back at the end. That's all.
One of the, and you have an event or a program that's called What Your Heirs Should Know, and about a reverse mortgage, because that kind of sometimes has been the big negative for people, is that they think they're spending their children's inheritance. Well, it's like, if you can keep your children from having to pitch in for you to live, then that might be a positive. And it's a discussion that the family needs to have. And that, again, is uncomfortable, but it's something that everybody needs to kind of go through on understanding. And now you talked about some of the amounts, and let's just do an example, okay? Let's say someone has a house that's worth about $800,000. Now, the amount of a reverse mortgage, Don, that you could have, and again, the amount that you can get is tied to your age. Is that correct, of both of the people that are living in the house?
Correct. And
okay. So you're going to get a little less than half. So if you're having $800,000 house, you're going to get a little less than $400,000. Is that right?
Yeah, you'll on an $800,000 house. First issue is that the maximum lendable value is $765,600. So any value above that, the way FHA's calculation works, if it's whether it's an $800,000 house or $1 million house, it will be treated for loan purposes as a $765,600 house with FHA. Now, the non-FHA products go into are basically useful for the properties above $1 million. And so I'm happy to sit down with those details with anybody. And if you want either of two things, I can put together a package like this one that has a lot of information in it for somebody. I can give you either this package, which uses a $500,000 house at age 62 and at age 80 for some examples, or if I get birth dates, an estimated property value and how much you owe, I can send you a package and tell you what's available on your house, and that's for free. I just
Yep.
need a little bit of information from you, and I send them out, and then you can decide what you want to do from there. You
So
do
for
have
those
to.
listening, I did copy and paste in the chat room. Hopefully you see that, Don's phone number and his email. And just go to your reactions and put a thumbs up if you're listening and you can see those. But otherwise, we'll be sending out the YouTube link of the whole thing. And in the description, we will have all the contact information for Don and Orion Mortgage. Because again, there's so many questions that come up when you first start thinking about a reverse mortgage. But to summarize what the point I wanted to make here was that if you have this house for FHA and it was around 800, he's telling us is 765 is the highest loan that or value that they'll give, you're going to be a little less than 400. So if you owe 100,000, you'll be able to access somewhere around 280 or so. Is that right, Don?
Well, it depends on the age. At what age?
Okay. Again, those are just kind of round numbers so that you can think.
Yeah.
If you owe a little bit on your house, you're going to have to pay that off, and then the balance will be available that you can use as your own line of credit. And it's less than a week. You send them in a fax, and that's interesting because they don't take emails, and then they send you the money back. And there you go. You have your own bank in your own house.
It's there. Do we have any questions from the participants?
Okay.
Okay.
I'm going to unmute you. And so anybody who has a question that we've been going over, just go ahead and speak up.
You can't afford the $60 for the test. They're going to keep coming to work if they have to go to work. They have a rent to pay. And
okay, I hear somebody's in the back there. All right. Nancy or Marilyn, no questions right this minute?
No. Can you hear me?
Yes, we can hear you.
What's the interest rate compared to a traditional loan?
Interest rates these days are typically adjustable, and we're writing most of them right now under 3% is where they're starting. But they will be adjustable based on the 1-year LIBOR, and the 1-year LIBOR index is below 1% right now, and the margins are in the 1.25% to 2% range, depending on what the loan is typically where we're writing them right now.
So they're all adjustable. They're all adjustable kind.
They're available as an adjustable or as a fixed rate, but the way the structure is right now, the adjustables will get you more money, and if you want the line of credit, it has to be adjustable rate. There's nobody that's going to do a loan today and give you the money 20 years from now at today's rate with no interest in between.
Okay.
If it's the fixed rate product, then you get the money out at closing and you're done. There is no line of credit with a fixed rate product. Any quote that I put out has both the adjustable and the fixed rate product in it. You can have either one. It doesn't matter to me. We'd love to have your business either way. And that's the benefit to a specific proposal, is because the proposal would give you the interest rate, the costs, and the whole thing all in one bundle.
So Marilyn, do you
And-
see in the chat room, do you see Don's phone number and email there?
I am walking around. I was in the car, so I'm
Oh,
kind of
okay.
just,
Well, good
yeah,
for you.
no,
Anyway,
no
well,
hands.
we can get it to you.
Yeah, no problem.
So Miss Nancy, do you have any questions?
No, I was wondering about the interest rate, but I'd also be interested in closing costs on that. About how much is it to get that type of loan?
Closing costs can run anywhere from $0 to $25,000, depending on your situation. The biggest expense is FHA's upfront mortgage insurance is 2% of the value of the property. And then the other closing costs, appraisal, credit report and stuff is about $3,000. And then the origination fee can be from $0 to $6,000, depending on what interest rate you choose. And so those are the big lumps involved in it. But if you go to a $765,000 house, then you've got a little over $15,000 in mortgage insurance is kind of the big chunk that that hits it,
So
and that goes
think,
to FHA.
I
Go ahead.
think Nancy, in looking at it, if you're getting $400,000 out of your house, your biggest part is the 2%. So there's
Right.
$8,000 right there in PMI. That's for the mortgage insurance. So it's going to be somewhere $16,000 to $20,000. And I think that the thing that, as a real estate agent and as an individual who has a reverse mortgage, that it really is just the investment in knowing that I have that line of credit forever. No one can ever take it away from me. If I do some flips, I sell a house, buy a house, I can come in, pay off all the interest, and my equity comes back. I can use it to fix up houses. I mean, there's just so much I can do with it, and I don't have to deal with a bank. And I think the other thing is that some people at this point may not even have qualifying ability, but all you have to qualify for is the HOA, the taxes, and the insurance. That's it. So you have people on Social Security that can get this and make their life a lot easier. So we just have to take this stigma away from the fact I have a reverse mortgage and say, no, I'm really smart because I'm going to have this in place. So when all of these cow pies that eventually will come into your experience, guaranteed, you're ready with the money to be able to handle them. And then whether you pay it back or not pay it back, you're not touching your other investments. You're not touching your IRAs or your retirement account because you're using the equity in your home to enhance your life. That's the way I see it. But it took me a lot of these classes to get to that point. But I feel confident in telling you it's a good thing for some people.
Yeah. Well, you just hit on one. The only thing I've been tempted to use ours for was I had a real estate agent come to me with a house that was heading to foreclosure, and I told him if he could get a listing on it, I'd make him a cash offer on it. And because I could pull the money out of the reverse mortgage and pay for this thing cash, but somebody else ended up with it because they were willing to pay more than I was for it. So it's a way to do that, and it's been used that way before. So.
And to not be using your own resources on a monthly basis to pay back a loan. If you have a line of credit, you got to pay that every month. You got to pay that payment. So you have to factor that back in when you're saying, what's my profit on this investment that I got into? So anyway, I believe that it's a tool to help, and the cost, there's investment, your return on your investment is like, what can you do with this? And if you can make your life be a little bit better because you have access to it, it's then just a value choice on your end. So
I look at it like the cost of insurance. It's insurance is something we pay for and hope we never use. And
Yes.
it's
So Moto G5 Plus, did you have a question?
Have introduced will allow for families to claim that $500 for their dependents who were born this year right away. Because parents can't wait until next year for money to buy diapers and formula, car seats, and all of that.
Am I hearing that? I'm not sure that's a
I think
question
it's,
for you or something in the background.
I think it's something in the background. You
think
might
so
have to
too.
mute his mic.
Okay. All right. Marilyn, did you get your question answered?
I have one more.
Okay, great.
He keeps talking about mortgage insurance, and I haven't had to pay that ever, and I'm just curious on how that works. Obviously, there's a 2% charge at the time of closing, but
Right. There's
It's cost.
2% at the time of closing, and then 0.5% on the unpaid balance each year after that. And people say, why do we have to pay that? Well, it covers two people in the process. One is that this product has a guarantee from FHA that the money will be there. So if the lender goes out of business and you've got a $400,000 line of credit, FHA will step in and make good on that money and make it available to you. The other side of it is that they guarantee the lender against loss. The loan is a non-recourse loan. What that means is that you will never owe more than the house is worth. Your heirs will never owe more on the house than it's worth. And so if you end up upside down in the house, this one becomes a non-recourse loan. It's about the only non-recourse loan you're going to get on a house, because the traditional loans, a lot of people don't realize, is that you're signed on it personally and they can go after other assets to pay those loans. But with this one, that's not true. It's the house is the only collateral for the loan.
okay. So 0.5% per year on the unpaid balance divided by 12. When do you make that? Does that go into your reverse mortgage, that charge? Or do you
It
have
all
to pay
just
that
adds
monthly?
to the loan.
Okay.
It all adds to the loan balance. You don't have to write a check for any of that. The only cash item we get involved on these is that we typically ask people to pay for the appraisal up front, because you don't have to close on the loan, and I'd rather not be buying appraisals for people who don't want to close the loan. But otherwise, everything gets rolled into the loan on a typical transaction. So it's not a lot of cash out of pocket. You do have to qualify. The qualification process basically follows VA qualification requirements, and it's a residual income calculation. If you're familiar with that, you need to be able to cover all your payments, taxes, insurance, maintenance, and for a couple have about $1,100 a month for gas and groceries, and for a single person, it's, I forgot, about $600 a month, which means that you're walking, you're not driving, because with that residual income, if you run the numbers, you can't afford a car when you can't qualify. But we've had people come to us who could not qualify because they allowed their financial situation to deteriorate far enough that they could not qualify for the reverse mortgage.
Okay.
The one more thing I wanted to put in here is that with the current real estate market changing, okay, because of what we're going through, and it's not a negative, it's just a reality that you have people pulling their houses off the market who are discretionary sellers, okay, and then what that does is it leaves on the market distressed sellers. Okay, so our values for a while might be starting to come down. So this is kind of a snowball effect, having been through 3 different markets, and it happens pretty quick. So if you're thinking about getting a reverse mortgage on your on your property, you should probably start now just to be able to have the value higher. Is that something you might chime in on, Don? Because it's like the longer it goes to where we get lower comps, the lower the value is going to be on your property when it comes in.
That speaks to last Friday's closing. The one spouse was over 62, one was under 62. We can do that with the one under 62 as a qualified non-borrowing spouse. They were concerned about future drops in real estate, so they wanted to get it done now before the pricing went down. And so by setting it up that way, the reverse mortgage can go in place. They can set up their line of credit. As long as both spouses are in the house, the loan is in place. If the older spouse leaves the house, the younger spouse can stay for the rest of their days, and they've got a place to live without a mortgage payment. So there are opportunities for people where one spouse is over 62 and one under 62 may want to, if that's the consideration. I've talked to people who think the market's going to go up. I've got talked to people who think the market's going to go down. Some of them are going to be right. Some of them are going to be wrong. My crystal ball is very cloudy on that, and but you pays your money and you takes your choice on which way you think it's going to go, and make your decisions on that. And 10 years from now, we'll know who was right and who was not.
Well, you know, the thing Tom and I were actually talking about, Tom's my husband, but is that they could actually, who is they, you know, the FHA, the government, could actually terminate any options for reverse mortgages, and it could go away. I mean, don't you think, Don? I mean, it could happen.
Oh, they have changed the rules, particularly since 2013, and most of those changes have not been beneficial for the borrower. They've over that time, they've implemented the qualifications on income, assets, and credit. They've reduced the principal limit factors. And that's the biggest risk in the product, is what's the government going to change in the rules. We got ours. We scrambled to get it done whenever we did, because there was a rule change coming, and I had 30 days notice that the rule change was going to hit. We got our FHA case number before the rule change, and it saved me a chunk of money on the upfront mortgage insurance, because it went up at that time, and I got it before the change. So yeah, they don't give us much time when they change the rules. Sometimes there's some notice, and sometimes there's no notice, and they can change the rules. So it's like everything the government does; they can change the rules anytime, and once they're changed, they're done.
Yeah, the biggest obstacle, or the biggest cow pie for people to get through at this point, when they're deciding if they want to do a reverse mortgage or not do a reverse mortgage, is just get over the cost, and then just get it on your property so that you're prepared, because there are going to be things that you are going to need money for that you don't want to take out of your IRA or an investment that may have dropped, and you're waiting for it to come back. You can just take it out of your house, and then when it comes back, you can pay off and keep that cycle going. I mean, that's the way I look at it, that it's really the insurance policy that you're going to be able to take care of yourself and the things that come up, and in a calm, business-like way, that it's not going to cause stress on your family or your kids, because you've got it taken care of. So. And
the other thing not to forget is that these can be refinanced. If the market goes down, it will not reduce the amount of money that you have available. If the market goes up dramatically, they can be refinanced and increase the line of credit because of an increase in value in the market. The biggest one we've seen was somebody, we refinanced their reverse mortgage. They picked up an extra $100,000 in the process of refinancing it. We've done some of those refinances with no cost to the borrower. The only restriction FHA puts on them is you cannot refinance them in less than 18 months. So you've got to wait 18 months and then they can be refinanced. There's no prepayment penalty. You can pay it off anytime. So there's no restriction on selling the house if you need to move, if you want to move. It's like any other mortgage. You get a payoff statement, sell the house, pay off what you owe, and walk away with money. That's
so the one thing is, if you're thinking of you know, getting another house that you would want to move into, you would have to buy it as an investment property, because to get a reverse mortgage, you have to be an owner occupied. What you do
right.
with the money afterwards is a workaround. So you can give us a call and we can sure talk about the options that that you have there once you have access to the money. And that's the key, is just having access to the money. So let's see, Nancy, any other questions for you?
No, I don't have anything at this time.
Okay, great. Well, thanks for coming. How about Marilyn? Are you good, or?
I had a concern. So
What's that?
I had a concern. Can you hear me?
Yeah,
Sure.
we can hear you.
Okay. You know, you get a reverse mortgage on your house now, you live in it 10 years, and you become more incapable of taking care of a house, and you have to move to another facility, whether it be an assisted living or just another patio home or something like that. Obviously, if you haven't made your payments, obviously your balance due would be more, and it would probably curtail your ability to buy another house unless you did another reverse mortgage. Can you enlighten me a little bit? I'm worried about the next step.
The next step is that if you are, you got two issues there that kind of overlap. One issue is the one of maintenance on the house that you're in, and people get concerned about how they're going to take care of the lawn and the painting and those kinds of things as they get older. And the answer for that is call Mark over at Number One Son, and he can take care of all of that stuff for probably less than what you'll pay in HOA fees on a patio home or something else. If you look at $300 a month, he can probably cut your grass, paint the place, and do whatever else for a lot less than that on whatever house you have. And I used him whenever we got our reverse mortgage. I needed the house painted and a couple new decks, and I said, Mark, take care of it. And I gave him money, and he took care of it. The other issue is the move, and the perception is often that you're going to buy the big house whenever you're in your 40s or 50s, and then come retirement time, you're going to move down into a smaller house. Well, you can move to any place you want to go, but a realtor told me more than 20 years ago that if you want to save some money on the house, you have to move down by at least a third, because you're going to have, round numbers, 10% come out of the middle just in closing costs and moving costs and all this stuff. And people challenged me on it, but they end up spending that much out of the middle if you move to the same house across the street. And so what that puts us in is a situation where if you have a $750,000 house, to save some money, you have to move to something under $500,000. That's a tough move to make work in this market. If you're in a $600,000 house, you're looking for something under $400,000. And you know those numbers are even tougher to make work. And so economically, the only suggestion I make is that before you sell the old house and decide to move someplace else, take a look at where you're going to move to and make sure that the economics of it really work, because for the price of the move, or a lot less, one of the people at my panel this afternoon can show you how to modify your house to take care of those steps They can take care of about anything in the house and make it livable long term, and you just stay put. And the economics probably will lend towards staying put, contrary to what Kara would probably prefer, that she gets paid to move you, but it's tough
No,
to make the numbers
this is
work.
about, this is totally about what is best for the individual. It is not about a commission. It is like, how can we help you? Because this is traumatic, of turning into your 60s and then into your 70s, and it's like, what am I going to do? There is no manual. And so we're all in this boat together trying to figure it out. And if we can figure it out before it becomes the fact that you can't do something, that's what our goal is to help people be able to navigate those cow pies with grace.
I'm teasing you about it, but be careful about referring to these people in their 70s as being the old folks, because
No,
that's
I
me.
wasn't. I was like, I'm there. I have double sixes. You know, this stinks. I mean, I was great with the 50s, but man, when I started with the 6, this has not been my favorite decade.
What's that? Well, I'm past the 6s and I'm into the 7s already. So, yeah, that's one of the issues that it's been for me, is that as I've moved into this age group and I start looking around and dealing with people my own age, this stuff has become reality. It's no longer some distant thing. It's
And the greatest reward is helping people take away the pits in their stomach. I'm going to call it like it is. Doing this whole aging thing, it is not fun, and your kids do not want to talk about it, period. Because you've been their rock, and now they're like, oh no, we're not going there. But it's like, if you go there to begin with, then it can all fall into place so much easier. That's all I'm trying to do, is take away the anxiety and create the balance in a calm, peaceful transition in your life. And whether it's stay where you're at or do something different. Now, Don does not do forward reverse mortgages, meaning to purchase a new house on a reverse mortgage. But we have plenty of different mortgage brokers who specialize in reverse mortgages, and Renata Anderson is one of them, that really takes you by the hand and helps you figure out which is going to be better, which is what Don was talking about.
Yeah.
Is looking at your numbers and how much equity is in the house now versus how much you need to put down to not have a payment. And it's a lot of work. This is not easy. So I want this to come out, that it's definitely it's a task, and it has to be taken seriously and looked at with maybe your financial planner. And if you don't have one, we certainly have some of those that can sit down and look at it. And it's really about starting with all of your bills, your cell phone, your insurance, just getting a whole picture of what it costs you to live and what you think it's going to cost you. And it's like, so can we get the Stars Extra on the cable? I mean, we're talking about that. And yes, we need to have the coupons to go to lunch. And anyway, it's a process.
I'm just at the point where I can still laugh about this stuff, even though it's deadly serious stuff, but I can still joke about it. There are some people who have trouble joking about it or whatever, but that's where it is. And I'm happy to chat about it, answer anybody's questions. Marilyn, you're unmuted, like you might still have another question.
Nope, I'm fine.
Okay, good. Well,
okay.
Thanks for stopping by. And so we'll, over in the chat is, again, all of Don's information. And if you've showed up, we'll be sending you a video so that you can kind of go over it again. And please feel free to call or email Don and check out his other events, because he has a lot of them. And it just takes a lot of dot connecting to figure out what is best for you. And then you're just going to have to take the plunge. You're just going to have to jump, get to the cliff and jump. Because otherwise you're going to sit there thinking about this, thinking about that, and you won't ever make the decision. So hopefully when people are watching here, it's like, it's okay to make the decision. It's okay to do that, you know? So anyway, so thank you, Nancy and Moto G and Marilyn for stopping by, and Don and Declan, if you could stay on here, I need to do a little bit of finish up, and thank you everybody else for stopping.